Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be analyzing Adobe stock, ticker ADBE. This one came in by request down in the comment section of one of my other videos. If you have a request of a video of a stock you'd like me to make a video on, just post it down in the comments. I'll get it on the whiteboard behind me. A lot of those are crossed off, so I am working my way through my list here as time goes on. Took a couple days off this weekend, which I hadn't done in a while, so that was kind of nice to get to come back fresh today. And Adobe is a pretty interesting stock to look at. As always, this is not individual investing advice. This is just how I analyze stocks. I'm going to be using fast graphs for a good portion of this analysis, which helps me analyze stocks pretty quickly, especially in the early stages of the analysis when I'm sifting through stocks. And I'll have a 25% off discount affiliate link down in the description if you're interested in trying out fast graphs. I've been using it for like 5 years. I actually reached out and contacted them to see if I could get an affiliate link because I use it so much and people kept asking me about it, and I was like, well, maybe I can support the channel a little bit that way. So that's where that came from. So let's just get into the analysis here. So this is going to be, if we look at the historical earnings, they've been really steady. They had a 1 year here where they maybe 2 years where they kind of declined a little bit. This dark green area is the earnings per share. So yeah, we have this decline here. I don't remember exactly when they started switching to like a more of a subscription model, but it might have been during this time. It looks like the market didn't pay any attention to this earnings decline. And I wasn't following the stock super closely back then. But the recent trend has really just been steady secular growth from Adobe. Let's shorten it to like 2015. We'll do 2015. I think that's what I do in my analysis. So, and get myself out of the way a little bit here. Okay, so I did almost buy this stock right down during this dip. I'm a little bit, if we just look at the overall growth here, so we had this super fast growth period here. And then since 2019, if you kind of look at just the overall growth, we had some stimulus money come into the economy here, which probably boosted growth for a couple years with the pandemic and everything. And I mean, to me, this is like about 15% earnings growth. Average, and if you look at what analysts are expecting going forward, it's more like low teens. So if you just average, well, we can look and see what the fast graph says. So fast graph is showing like 27% earnings growth during this time. I always limit my earnings growth expectations to 20% because I'm going to be forecasting this out like 10 years into the future. It's pretty rare for a business to be able to grow 20% 10 years, especially one that's Adobe size, which is $200 billion. So they'd have to grow to like, a couple $1 trillion over the next 10 years, which maybe it isn't impossible, but I don't like to assume that in my valuations. But for these guys, I just looked and I thought, 15% earnings growth is probably pretty fair expectation going forward. Depending on how earnings come in, I mean, if they come in a little slower, I might lower that down more closer to 10% going forward. But right now, I'm sticking with that 15% estimate. But with a little bit of a caveat that I'll get into here in a minute. So if we just look at the basic valuation, well, let's look at just to show it. I don't even know what it's going to show. So this is why the stock might be interesting to some people. If you look at their average PE during this time, it's actually quite low. It's much lower than where it is trading right now. That's this blue line. So it's been averaging a 41, we'll call it a 42 PE. If it was to trade back up to there, I think I can do this. I don't usually use the mean reversion anymore. But if it was to trade back up there, you're looking at, a 60% move in the stock. And it was up there during kind of 2020, late 2020, it looks like. Or late 2021, sorry. But because earnings growth is almost certainly going to slow down, we probably shouldn't assume that it will revert back to that mean. And so that's that, along with rising interest rates and things like that. I think it's a little bit optimistic to assume that a stock like this where earnings growth is still good, but it's just slower than it was historically, would trade at that higher PE ratio. So the method I use isn't going to assume that it will return to that type of valuation. I mean, it's at a 28 PE. That's pretty high anyway. So I'm going to assume that it's not going to revert there and use a kind of a different kind of analysis. Let's see. The other thing is they have this acquisition of, I forgot the name of it, but I could probably look at it really quickly. I don't know if I have I'll just do this really quick. Since it dropped Figma, that's what I was trying to remember. Okay, so they have this acquisition of Figma. So when that happened, I got a little bit scared because I think it's a sign probably that they definitely see some either disruption potential, or they really feel like they need to invest and adapt to keep growth going. That's usually kind of it can work, but it's usually kind of a danger sign where like the easy growth has probably been mostly, they've probably mostly gotten most of that already. So another reason I think to just be a little more on the conservative side. So getting into like the actual valuation here, I'm assuming 15% earnings growth. That could come down. I'm kind of giving them the benefit of history. Also, potential inflation that we could have that we haven't had until recently could boost kind of nominal earnings growth. And then they've been coming in pretty solidly in that teens area. So it's kind of just a mix up. I actually lowered this before they started having the slower growth. So I kind of anticipated it a little bit, and I think that was the right thing to do. So I'm going to 15% earnings growth for all those reasons. Earnings this year are expected to come in at $17.97. I don't think there's too much of an adjustment to make for, there's not. They don't really have any debt that we can see here relative to their cash anyway. So this is a pretty straightforward analysis where we take the earnings yield, which is 3.85%. That's the inverted PE ratio. So, and what I like to assume is if I bought this whole business for $100, it would pay me back $3.83 the first year, and that would grow at 15%. I do pull the first year's growth of earnings forward. We're already partly into the year, so it's just a way for me to do that. It makes me calculating this a little bit easier. So I actually assume that in 2024 we'll get $4.41 in earnings for every $100 that you invest. And then that $4.41 grows at 15% each year, and this is how much you would collect over time on your $100 investment. So I like to go forward 10 years, which is right about here. So over 10 years, you would collect about $190, or you collect about $90 on your $100 investment. So you'd go from 100 to 190 in 10 years. Put that in a CAGR calculator. Should come out somewhere close to 6.6%. This is right in the middle of like fair value for me. Just my generic kind of where I think of probably fair value for most businesses long term are. As long as they're growing earnings. The market is actually more expensive than this right now. I think the market's more like 5.5% over 10 years, like in terms of the S&P 500. And then to get to a buy, I like it to be above 8%. So it's kind of in between where the market is, where I would potentially buy it. So just using like without assuming a recession or anything. So my buy price is at $324, which is about 30% lower than it is right now. We did see that it was lower than that. It was like down to $275 or something like that during that 2022 decline. So it could definitely, I think, get down there. Right now things are trending down for the stock. So, we were looking at getting down to what, like right in these levels, right in here. So that's just early 2023, like a little over a year ago. So any kind of disappointment could send it down. Now, because this is a little risky in terms of what earnings growth is actually going to do, I also have a momentum factor that I want to be met as well. So basically the idea would be, because there's risk of earnings miss, competition, slower growth, things like that, you can tell that the stock has lost, let's see, just in the past 2 months, it's lost almost 30%. So it's falling quite rapidly. So what I would want to do is have it come down, dip below my buy price down here somewhere, and then show signs that the momentum is recovering. And that's when I would feel kind of comfortable coming in and buying it using this process right here. So right now the momentum, I use this, it's a momentum score from, it's actually a grade from Seeking Alpha. And I think if you're a premium member there, you can get access to that. I just occasionally go through and track to see if it's something that's close to being a buy, and I'm looking for that momentum. I want it to be positive. So it's not too bad now, but it would probably have to get worse and then get better. And you could use like a 200-day moving average or something for that too. If you don't want to look at like the momentum score, you can use your own or whatever, or just look at a commonly used one. So that's one way to do it. That's probably actually the way I'm leaning with this one. I think there's a decent chance it could come down to like 300, stay down there a little bit, and then maybe recover at some point, and then I would be willing to come in and buy that recovery. Now the second way to do it is to assume a recession valuation. I'm not going to go super into the details on this. I do it like every other video. But I used the 2020 drawdown and the 2008 drawdown as my example. Sorry, as my metrics, gauges for what it could do during a recession. So if we did have a recession and it behaved similarly to those two crashes / recessions, we're looking more like a 216 buy price. So it definitely has the potential to go much lower. And I base that on the peak earnings to the low price. And again, you can watch some of my other videos where I kind of explain that a little bit more. I think if we go back here, see, we're looking at like a 10 PE, much lower than where we are now. So I think now I probably won't use that unless I know we're in a recession and I know I can get a chance at a cheaper price. I'll probably use the basic valuation and the momentum and just see if I can get lucky enough, that the market kind of gives me a chance to get into it. But I definitely track it. I definitely want to be willing to buy. I know I was pretty close to buying it there because I think at one point I added, it might have just been that momentum that by the time it picked up, the price had risen above my buy price back then. I think that's what happened. So it's definitely one to keep an eye on, but I don't think I don't know what they're going to do, but it's not super cheap yet. 28 isn't really super cheap, even with 12% growth or 13% growth. So we want it to be probably below like a 20 PE. All right, if you found this helpful, hit the subscribe button. I do have a free Patreon tier now, and if you want to join the full Cyclical Investors Club service and you join the $5 tier over on Patreon, you can get a big discount if you ever decide to join the full Cyclical Investors Club service. I'll have all those links down in the description, and I'll see everybody later. Bye.